Right? We have record trade deficits, we have record budget deficits, and none of those are going to get better now that Biden is coming in. And in fact, we just had the special elections in January, and now the Democrats have the Senate. So you have a Democratic Congress, a Democratic president. These guys are going to spend even more than Trump did. And Trump was a record spender and record borrower, cheerleader for money printing. And, certainly you're going to have an even bigger cheerleader now that Biden's there. I mean, his whole team, it's all about MMT and, free this and free that. And so I don't see how the dollar is going to rise in this environment. Look at what's happening to commodity prices across the board. You have commodities hitting 5-year highs, from the industrial metals like copper to the grains, corn, wheat, soybeans. I mean, everything is going up, and it's not because we have this booming economy. We still have COVID. This is all inflation. It is money printing that is driving the increase in prices. I don't see how the dollar can thrive in an environment like that. And look at what's happening to interest rates. The 30-year Treasury is knocking on the door of 2%. And if the Fed lets it get through 2%, it could make a beeline for 3 or 4. And the over-leveraged economy can't handle that higher rate, even though historically it's still low. So the Fed is going to have to print as much money as necessary to artificially suppress long-term interest rates, which means massive creation of dollars to buy more treasuries. How do you get a stronger dollar when the supply of dollars is going to go through the roof? I mean, it's basic supply and demand. If you get a lot more dollars, those dollars don't become more valuable. They become less valuable.
I'm with you. Okay, so there's a bunch of stuff in there I want to unpack. And beginning, with the runoff in Georgia, Democrats taking the Senate. Biden's now going to get approval likely for his $400 billion clean energy stimulus, right? It's supposed to be distributed over the next 10 years. Do you think that's the whole picture, though? I was talking to E.B. Tucker yesterday. I mentioned the $400 billion promise towards clean energy, and he's like, that's just the appetizer. Get ready. It's going to be way bigger than that.
Yeah, look, what these guys don't realize, though, is that we're broke. I mean, we can't even afford to make good on the promises that we've already made, let alone the new ones that the Democrats have, already bribed the electorate with. And, look at what's happening to oil prices. Oil prices went above $53 a barrel yesterday. Who knows where they're going to be, soon. But I think the prices are headed much higher for oil. People are going to be very surprised, I think, by the oil price. But, the big difference, we had $100 a barrel oil years ago, but that's when the U.S. fracking boom was really going. And so we were producing a lot of our own oil, and so we didn't have to import as much. But I think that the next time oil hits $100 a barrel, which could happen this year, we're going to be importing record amounts. I mean, our industry is a shadow of what it was the last time oil was at 100, and it's not coming back. It's not like all of a sudden oil prices are going to go up and then we're going to start drilling again. A lot of money was lost by investors the last time because that oil was very expensive to get out of the ground. And so I don't think the investment community is going to, step up again, given how much they've already lost. Yeah. Plus, I think that it's very likely that the Biden administration is going to further increase the cost of domestic production with more regulation. So they don't like drilling, they don't like exploration, they don't like fracking anyway. And so it's going to get more expensive. And so our record trade deficits, right? And the trade deficit is at a record high, despite Donald Trump's promises when he campaigned. He is leaving the office with a trade deficit much higher than when he took office. I mean, it's record in goods. It's all-time record highs. Yeah. And I think it's going to soar when we have to pay for $100 oil to import. And so that's just going to put more downward pressure on the dollar as it puts upward pressure on trade deficits and interest rates.
Right. How much how much will the oil price be impacted, Peter, when we're allowed to travel again? Like, do you think there's a lot of pent up demand right now, recreational business travel. That's just, we can't go anywhere, right? But that demand hasn't left. I mean, I'm happy to stay at home. A lot of people aren't.
Yeah, I mean, obviously, as more people travel, the demand for energy will pick up, and I think people will return to traveling. I think it may be a more gradual return than people expect. But remember, there's also been a big reduction in supply, and so you have two sides of the equation to determine price. And so if supply has gone down more than demand, prices can still go up. And I think that's what's going to happen. And of course, if the dollar continues to fall, which is what I believe will happen, that increases demand for oil outside the United States, not necessarily for travel, but for other things. And it certainly is possible that the rest of the world could start traveling long before Americans do.
Okay, so I know another trade you're watching and participating in is the emerging markets trade. Talk to me about the relationship between a falling dollar and the emerging markets trade, Peter.
Yeah, a weak dollar is the best thing that could happen to the emerging markets because it was a strong dollar that was so detrimental. So it's the strong dollar that was hurting emerging markets because a lot of the emerging market companies have US dollar denominated debt. And as the dollar strengthens, that made it harder to service the debt, certainly harder to repay it. It would put downward pressure on their currencies, which might put upward pressure on domestic inflation rates, which might force central banks to have to raise rates, even if the economy was weak, in order to, support their currency and fight inflation. So the strong dollar was a major headwind. The weak dollar is a reversal of all that. It becomes a huge tailwind for the emerging markets because now all of their dollar-denominated debt becomes easier to service and cheaper to repay. And if commodities go up and if they're exporting commodities, then their terms of trade improves. And of course, as their currencies start to rise, now emerging markets look more attractive to global investors who want to participate in those strengthening currencies. And so the money flows into those markets. And why I think the emerging markets are going to be particularly strong this time is because if you go back to the last time there was a lot of money flowing into the emerging markets when there was a weak dollar, a lot of these emerging market governments and central banks were worried that their currencies were getting too strong. And, they had the currency war. Everybody was worried that they would somehow lose a competitive edge in exporting to the US. And so they were trying to fight the rise in currencies. I don't think they're going to do that this time. I think these emerging markets are going to be happy to see the US dollar decline.